Welcome and good morning to you all. Thanks for joining us here this morning. And to Tim, a special welcome and thank you for joining me here today and sharing about your business. And we appreciate the fact that you're going to be very open today.
Pleasure, Brett.
Tim, I was actually reflecting on how long we've known each other, and I think it must be 25 years or so.
Try to be kind, will you, Brett?
Yeah, it could even be longer. But the amazing thing is that I think you and I both don't look any different to how we were 25 years ago.
Absolutely not. I even shaved and put on pants especially.
Oh, fantastic. I thought you were actually going to say that we're both smarter and wiser now, 25 years down the track. Tim, you've had so my name is Brett Menny, head of managed portfolios at Hub24. Tim Townsend, partner and a planner of Townsend Cobain. This interview session will run for around 30 minutes. So, Tim, you've had an amazing journey in the industry. You headed up a new financial planning business for Outlook Credit Union in the late 80s, I believe it was, and building it up into a very successful enterprise. You're one of the early adopters of master funds and then the move across to wrap accounts. You've had a career with perpetual private clients in their advice division, and then as CEO of the financial planning division of WHK Group. Then spent some time back in practice, successfully building up one of WHK's financial services and accounting practices in the Melbourne CBD, before joining forces with Rod Cobain in setting up your own financial advice firm, Townsend Cobain, 7 years ago in 2003. 18 months ago, you reviewed the way you do things at Townsend Cobain, and today we want to explore what that was, why you did it, how you did it, and check in on how it's been working for you, particularly in the testing environment of COVID-19 and extreme volatility, the period that we've just been through and continue to be through.
Yeah.
But before we begin this journey or your journey, to get a broader perspective on managed portfolios and managed accounts, I'd like to share with everyone some really valuable insights and hard data survey results, which have just been released from our friends at Investment Trends, about the advisor usage and advisor insights about managed accounts. So this survey was drawn from some 900 advisors in February of this year, January and February, has been run for 4 years now. So it's very useful information in understanding the preferences, patterns and trends around how advisors are managing their business and also managing with managed accounts or managed portfolios. So there's three things I'd like to share with you. Firstly, that managed accounts are growing at a very, very rapid pace. 22% of advisors were using them 4 years ago in 2016, and growing to now being 40% usage across all advisors in that sample set in 2019. Projecting forward, based on the results of the survey, managed account assets are projected to grow by 50% in just 3 years. So that's to 2013. By contrast, ETFs are expected to grow by 30%, and unlisted actively managed funds are expected to shrink by 20% by 2023. The second interesting thing I'd like to share with you is the reasons why managed accounts will outstrip anything else in the industry. So Tim, if you can flip to, so this is really looking at why advisors have been recommending managed accounts, and there's multiple responses to a whole heap of factors, but the simple explanation of it, if you look at the right-hand side, is clusters, what Investor Trends call clusters. So the pleasing piece is that client benefits were the biggest driver, shown in the dark blue bars. And that's things like allowing clients to see the underlying shares in the portfolio. In other words, transparency, things like being tax effective, so being able to manage the capital gains tax components. The middle section, which is the lighter blue, is around operational efficiency. And it's been seen as the most effective way of implementing model portfolios. It lowers the compliance burden, reduces risk in the business, etc. And the third component, not too far away from the other two, is around the value proposition that it's enabled advisors to articulate to clients, and also meeting best interest duty obligations, which is extremely important, and also facilitates the provision of more goal-based advice as well. The third thing I'd like to share with you is around time savings that are put back in the hands of advisors. An average across the survey group indicated that there was 13 hours per week saved per advisor in a practice. Now that is significant. That's nearly 2 days, maybe a day and a half to 2 days back in the hands of practitioners. And I've just called out the 3 bars by the red bracket, if you like, which is the area that has been the largest saving across this group surveyed. And they're really bunched up into the amount of time saving around selecting, researching investments for a client's portfolio, around the investment admin work, and around cutting down the time spent on preparing ROAs. So the dark blue is the original time taken by not using managed accounts, the green being the time taken in managed accounts, and the light blue being the time saved. So quite significant. So Tim, everyone has an individual journey, I guess, and has a different story and a different approach to what they're doing. So maybe just a comment first. Does any of that information from Investor Trends resonate with you?
Yeah, it does, Brent. I think that there was a range of issues that made us or caused us to go and start to investigate deeper the advantages of the managed portfolio concept and how that would be capable of improving our practice. I mean, just as a matter of interest, we don't run a large number of clients. Just to give you a little bit of a sense of our practice, even though having commenced 7 years ago, we probably look after approximately 110 to 115 clients today, looking after circa 250 million, depending upon what the markets are doing on any particular day at the moment. And so ours is quite a boutique offer to those particular clients. But a lot of what you were just talking about definitely were the driving forces. I mean, we had been aware of the managed account concept for many, many years, actually, because, I mean, really it's been around 10 years or more. And whilst being aware of it, we continued to operate on our client consent basis with all clients on all portfolios, but were frustrated by some of the things that we were seeing happen as a result of that. And so motivation, yes, we wanted to improve administration, but the other thing was a total commitment to improving the outcome for client. We've always had a philosophy: we live and die by the client experience. We live and die by being committed to the client who pays us to do the work we do. And for that reason, it forced us to go and look closely at the pros and cons of the managed account structure.
Yeah, Tim, just maybe for the listeners, can you expand just a little bit more on this, on the size of the practice, how many planners, support staff, etc., that you currently have?
Sure. There's my business partner, Rod Cobain, and myself, who established the practice 7 years ago. We actually operate with two support staff, both looking after client management and administration. One of them also responsible for advice design and development. And we're probably getting to the point where we will enhance that support as we go, but cautiously. And again, one of the benefits of these decisions has been that our need for excessive numbers in staff support are kept under control.
Yeah. Okay, great. So you've sort of touched on, I think, just a little bit about why your practice decided to re-look at models and how you're going about it and your structure. What was your thinking? What were the steps involved in doing that? If I wind you back to maybe 2 years ago when you were going through this process.
Well, it's even longer than that, Brett. It was actually probably more than 3 years ago now that we really started to stop and look closely at this. I mean, I've always been a believer, as Rod has, that, you know, the concept of the model portfolio has a lot of weight. You know, we want to bring the best advice to all of our clients, not just a few of our clients. And to do so under a client consent basis had all the limitations that most of the people listening or watching this will actually already be aware of. You don't get things implemented. It takes you 12 months before you get all your clients in line with your best thinking. And by that time, your thinking's changed. So there's a constant feeling of leaving clients behind. By the way, never more so than in environments like what we're in today. The number of conversations I would have with advisors who would tell you boldly that, you know, they made a call and they were able to go and do something for their clients. And if you interrogated them in a bit more detail, you'd find it was their top 5 clients that got looked after. Everyone else was left on the battlefield.
Yeah.
And I must say, you know, as an advisor committed to the client, that actually leaves you with a deep sense of guilt. There's Andrew Inwood used a great expression the other day, this is not our first rodeo. And I thought, well, no, it's not. We have been here before. We've seen this type of situation. But the thing that has sort of burnt us a little bit is the feeling of not being able to act decisively, quickly, effectively, and across all of our clients. And I think that our looking at the managed structure has allowed us to implement some changes on that particular basis.
Yeah. Tim, what were the first things that you did in sort of re-looking at your whole business and how you wanted to take, you know, where you wanted to take it in terms of its structure and to not leave clients on the battlefield?
I think for us, it started with a realization as we talked to other people, and that's probably where it really started, was talking, I suspect, to many of the people that are online right now, talking to them about their experience, because some of them had already implemented managed accounts. And I was quite surprised when I found, talking to them, that I knew some of these individuals. I knew what their philosophy was or had been, and that the act of actually introducing managed accounts, you found them doing things very differently. You know, all of a sudden, somebody who had used multiple levels of management previously, all of a sudden was predominantly holding direct assets. By the way, nothing wrong with that. But it really struck us that you kind of thought, well, hang on, did they end up there with purpose? Or did they end up there by accident as they tried to manage costs and things like that? So the first thing for Rod and I was actually sitting down and talking to each other and reconfirming our actual philosophy. And look, you know, we all talk about philosophy. I'm never quite certain exactly how you document it, but, you know, what are the fundamental beliefs that we are actually using the managed account structure to deliver? And has that changed to what we were doing prior to starting that particular journey? So I think one of the big things for us was actually redefining and reconfirming in a lot of the work we did our philosophy on what it is we wanted the efficiency of this type of technology to deliver. Because, at the end of the day, this is a technology issue. We can do things we couldn't do before. And one of the things you want to do is, yes, it will actually add efficiency to your delivery. But if you're delivering the wrong outcome, it just actually empowers more of the wrong stuff.
Yeah.
So that was a big thing for us, was to focus on getting the philosophy and making sure we knew what we were trying to deliver with the machine.
Can you talk me through a little bit more about what the philosophy is? Like, what did you land on, and what works for you?
Look, for us, we've always been conscious of the fact that, right today we sit in St Kilda Road. We have a limited range of time in our day. What does our day actually look like? How much of it is spent looking after clients? How much of our time is actually spent researching investments and things like that? And unfortunately, there's only so many hours in the day. By the way, just so we don't have a false impression, and I was just looking up at the screen that you were speaking to before, it's not like I go home 13 hours earlier every week. I get to spend more of my time actually doing things that adds more value, I think. And so, that has been a refocusing of our energies. But our philosophy, I suppose, has always been that we are willing to buy quality management from houses combined with a level of direct assets. And I say that in particular meeting the expectation of our clientele. They do want to feel, in our case, that we are involved in the investment decision making, but we don't want to try to hold ourselves to be the specialist on everything. And so we continue to run probably about 75% predominantly active management, and around about 25% through direct assets, which, since the advent of the managed account, is more actively managed in an SMA structure today than previously, where you would have direct assets reviewed at the next review meeting of the client.
Tim, thank you. Your investment philosophy is perhaps a little different to what's out there in the marketplace, with having, 4 or 5 risk profile portfolios, etc. I know you have a cash, a defensive, and a more growth orientated. So you got like three buckets. Can you explain that a bit more? If I was a client, how would you explain it?
Sure. I think one of the things we always felt, especially, we're dealing with relatively high net wealth clients. They do not want to feel like a number. They do not want to feel that I've just put them in bucket 3. Even though, by the way, that may not be a bad outcome, they just don't want to be in the, excuse me while I deal with the telephone at the same time.
Client, yeah.
Yeah, client. So the bottom line is that we wanted to be able to engage clients on a bespoke basis. So one of the things that we did was look at how we could structure this particular outcome. And the way in which we did that was actually to keep the model relatively simple. On this screen is probably an example of what we're actually dealing with, in the fact that we developed 2 SMAs, a defensive and a growth. We combine that with cash and term deposits, but we also recognise that whilst we run 2 managed accounts here, we also have the ability to hold client consent assets with the client. So if a client has a preference, if a client has capital gains tax issues, we continue to hold assets that may not form part of our 2 major buckets. But the thing we found by doing this, it's allowed us to engage a client with really 4 tools that we can bespoke the engagement with those tools to the needs of the client. I think the other thing that we found with this, I was talking to an advisor the other day who was commenting, was using the traditional conservative, balanced growth, high growth type pools. And they said that one of their frustrations is that their clients sell growth assets sometimes at the worst possible time. You know, they've got to take money out. They're paying a pension out of a balanced portfolio. Well, if I take out $10,000, it's going to be selling growth assets. And you asked me about philosophy before. I actually think we live more to principles. One of them is don't sell good quality assets when they're cheap. I know that sounds ridiculously simple, but in truth, if you keep telling yourself that, you start to build models that focus on those principles. And that is one of, you know, I think Rod gets sick and tired of me repeating these things over and over and over again. But that's only because I'm pretty simple. And the more I say it, the more I'm committed to that particular principle. And what this structure that you see on the screen in front of you now does is it allows us to ensure that people's cash flow is being managed without the necessity of being a forced seller of growth assets. Yep. It also, as you can see in these pools, allows us to combine both the managed investment expertise that we can buy from the marketplace, along with a set of direct assets. But, you know, when we started this journey, what we started to recognize is there's really 4 players involved. I think you should be able to see my pointer on the screen, and obviously Hub24 was the administration service that we selected to oversee these portfolios or to administer the portfolios. We continue to select managed investments where we see suitable, and as I mentioned before, that can be 60, 70, 75% of someone's portfolio. But this also forced us to go out and look for expertise in portfolio management, in other words, the ability to implement the licensing requirement, and also employ the expertise to oversee on a day-to-day basis the direct assets we may select for clients. And so for that, we spent quite a bit of time talking to different groups before settling on watershed capital management. And the thing we were looking for was somebody who we could bring in to beef up our expertise from an investment point of view. Somebody who lives and breathes the markets, while we live and breathe actually the client experience with an overview of the markets. So I suppose it was knowing our own limitations, but this structure, and I've been surprised by how few people in the managed account experience have gone down this particular path. Most of us have simply used the tool to replicate what we were doing yesterday, 10 years ago, 20 years ago. Yeah. And I think that's where I was a little bit disappointed in some of the conversations I had, because it kind of said to us, hang on, be careful, make sure that we think along these lines of what we were trying to achieve.
So Tim, if I can sort of comment on this or sort of summarise it a little bit, what I like about this particular model that you've implemented is the simplicity of it. Now, that's not to say it's easy or absolutely simple, right? But probably more controllable by you around the defensive portfolio and the growth portfolio and the cash holding. Easy for a client to understand, but also with the ability to tailor to the client's needs. So you're allocating to defence and growth based on the client's need, and maybe even the overview of yours and Watershed's view on when to take some risk off the table, but also the ability with a managed account to be able to tailor, even though you follow the instruction of the manager, but tailoring or substituting stocks out, or someone who's a director of BHP and can't hold those stocks, or an auditor, or whatever. So it gives you the flexibility of some tailoring. Would that be fair? Have I sort of got that right?
Yeah, no, you have. And again, this is the technology of the managed account. The fact that we can actually select specific direct assets that we never want to hold for a client, has actually done a couple of things. It's actually allowed us to, the example you just gave where someone doesn't want to own BHP, we can actually specify within the separately managed account of direct shares that we never want to own BHP. And if we, or Watershed, in managing the direct share SMA, chooses to allocate to BHP, they can actually say, no, the client wants that money to be held in cash. Or if you're going to allocate to BHP, the client wants you to buy this instead. And where that's actually become quite handy is it's allowed us to engage around ethical issues.
Yeah.
Not a perfect solution, but it's amazing when you sit down with a client and say, you would like an ethical overlay of your assets. Bit difficult with the managers, but that's something we're continuing to work on. But it does allow them to say, I never want to own this company, or that company, and importantly, feel a level of ownership of their own money, control. And I think, we're continuing to explore that to find the best way to actually give them control, because building a single solution when it comes to the word ethical seems very, very limited to us. Because when we talk to ethical for this client, it's totally different to what ethical means for that client. And so, again, we're trying to build that bespoke sort of concept for the client. Another point I'd make here is the fact that it's how much this seems to empower the client. Our conversations with clients, I'm finding, is more about the balance between defensive and growth rather than whether we should own more international or Australian. One thing I've learned through the years is that engagement with the client about whether we should own this stock or that stock, or whether we should own more international than Australian, doesn't add a lot of value to the conversation. But in coming up with these particular boxes, what we also did, again, principles, we defined what our word defensive means. Defensive for us is a combination of an allocation here and an allocation here. This is the defensive part of a client's portfolio. And defensive, our number one goal is preservation of capital through the cycle. And we try to earn $1. But preservation of capital is the goal of the defensive part of the portfolio. And that's actually aided us in not getting sucked up the risk curve in recent times in the pursuit of yield. Because you've got this mantra where you keep coming back, defensive is about preservation of capital. On the other hand, the growth exposure, which can be a combination here of the managed account or even the client consent assets that the client chooses to hold, this combination, we are willing to expose ourselves to market volatility in the pursuit of long-term returns. Now, they're just our statements. I'm sure most of the people listening to this can develop their own. Or, by the way, considering I've never come up with an original thought in my professional career, I steal them from everybody.
Thanks for your honesty, Tim. Tim, what I really like about what you've done here is the names of those portfolios too. Very clear for a client to understand, them being in a high growth or conservative growth and sort of boxed in to a risk profile. To me, if I was a client, I think I would get this pretty easily if I didn't know much about it. Has that been the experience compared to maybe how you were doing things before all of this?
Yeah, I think they are more engaged. I mean, different clients, different levels. You've got your clients you've had for years that just do, oh, I trust you, Tim, which is a terrible statement. And I remind them all the time that it ain't my money, it's theirs. And I suggest they get engaged to some level in the actual management of it, because the one thing we've learned is that everything we tell the client or educate them about before it happens is called education. Exactly the same thing after something's happened sounds like an excuse. I mean, we are in a classic case right now. Although we see markets back up again and remarkably close to where they were back prior to March. But when you have to manage clients through severe downturns, if they have absolutely no understanding, that's not a healthy place to be.
So Tim, I guess that sort of leads to a question around, your operating rhythm, and, what has sort of occurred in the last couple of months with a huge amount of volatility and swings and, I guess, clients' concerns about, markets, etc. So how have you handled that, the last couple of months?
It's been interesting because, it wasn't really just the last couple of months. I mean, as we came through 2019, I mean, an excellent return for markets and so forth, we were studiously under-returning against market. We were talking to our clients about the fact that, we were worried about markets priced for perfection. I mean, how often did we hear that comment? And if you're smart, I think you finish the sentence with price for perfection in a highly imperfect world. Gee, I wonder what could go wrong. We were not smart enough to predict bats getting involved in COVID-19 or whatever. But certainly that told us that we wanted to be more defensively positioned. And with what the clients had signed off on the managed account, we were able to do that. So our growth portfolio was really, as we came into this period of time, sitting around about 20 to 25% defensive. And what we were able to do in March very quickly as we moved away from monthly investment committee meetings to almost daily, we were able to use some of that cash to go in and start to buy into the lower reaches of the market. And now we didn't put all the cash to work, but all of those changes, I think, as I alluded to before, what was really important to us is for the first time, we moved and carried 95% or more of our clients. We were able to actually make those changes. Now, I'm not sure who let the dogs out.
That's me, I think. I'll have to go on mute.
You're right. You're okay. So the reality is that, we were able to make those changes and implement them quite clearly. By the way, that doesn't mean we're going to get all those decisions right. In fact, we would almost guarantee we won't, just as we guarantee the clients. We promised them a 40% failure rate. Yes, Mr. and Mrs. Jones, I promise you we'll get 30 or 40% of all the decisions we share together wrong. And the interesting point, the harder you drive issues like that with clients, the better position they are for the reality of the world we live in. I don't know anyone, well, I know people who will tell you they get it 100% right, but I also know people that lie. We are all in the position where there are so many variables that affect all of the things that we are involved in, that we understand that it takes a reality check. So yeah, we've moved with the markets. We've been able to make that happen, and the fullness of time will tell us whether we got that right or wrong.
Thanks, Tim. Just to recap on, you were talking about the four parts, that you had to focus on. One was the, investment philosophy, administration, etc. Can you just, succinctly sort of go, right, these are the four that you need to focus on if you were talking to someone else going through this?
Yeah, look, I think, and it was interesting because, you've got to go, once you've decided on the sort of structure you're building, you've got to go and find the partners that you actually want to work with. And the four basically were, we knew or felt that we wanted the licensing and expertise around portfolio management, the administration of the decisions that we were making. Who was going to get them implemented, who was going to do the oversight. And when we found Watershed to play that role and have been very pleased with that decision. We also wanted the day-to-day management of our direct assets to be managed. And again, Watershed with a track record was able to play that role for us. We wanted to find an administration service that was able to accommodate many of the best things that managed accounts are doing. And, as you're well aware, Brett, we went through that beauty parade and looked at the different providers and weighed the pros and cons. sometimes a very difficult process because, you know, there's always something that somebody else has got, etc. And you're trying to find that right mix. We continue to use managers and work with them closely as part of our offer. And then finally, what we also needed to do was constantly revisit ourselves as advice. So the 4 elements become advice, funds management, administration and portfolio management, and administration in the case of Hub24.
Great. Yeah, succinctly put, Tim. One other thing I want to sort of focus a little bit on is the client experience. So you moved clients from, you know, the old model, probably what model portfolios in a traditional sense, into managed accounts and a different structure. So how important was communication, and, you know, did clients embrace it? And probably a further question to that is, have they noticed the difference? And are they happier with the difference? And if so, why? A lot of questions I've thrown you.
Yeah, a lot of questions. How did we engage them first off was interesting, because one of the things that, again, if you don't admit to shortcomings, then why are you coming to me with a new solution? So the first thing we did was redefine in their mind how we were operating prior to this decision to make these changes. So we actually went back and visited that, and then did in front of them a SWOT analysis. You know, we talked about, you know, this was good, but these were the weaknesses. And this is what we, you know, and I told them about the fact of how I feel in the fact that not being able to carry everybody. And gee, I'm not going to meet with that client for 6 months before we get changes made, and they'll probably be out of date by then.
Yeah.
And people get that. You know, we all know nothing's perfect. And it was really interesting how, because what we were then doing is saying, and this is why we've made these particular changes. And by the way, whenever we do that, we reassure them, and we're going to be having this conversation again and again and again in the years to come. Our job, Mr. and Mrs. Jones, is to be in the market representing you. Technology is changing. The world in which we invest is changing. And I would have thought, Mr. and Mrs. Jones, that you expect us to be constantly asking and questioning the way in which we do things. And as a result of that, this is why we're taking these particular steps. By the way, in some of our clients' cases, this is more expensive than what we were doing before as far as fees are concerned. Not to us, but, you know, we've got a portfolio manager to be paid for now that wasn't being paid for before. So, you know, this was not about the pursuit of cheap. And by the way, that's one of the mistakes I see a lot, well, in my opinion, a lot of mistakes we make. But don't get me wrong, the easiest engagement with the client is to show them 1% and 0.5% and say, aren't I a hero because I'm going to get you 0.5. If I was the client, I'd be inclined to say, for what? What am I actually going to get for what I'm paying? So the concept of just pursuing, and even the regulatory environment that we're being exposed to today is almost forcing you, oh, well, you can't possibly charge a client more. What rubbish. What rubbish. I mean, if I'm going to go down and buy a Toyota, or I'm going to go and buy a Mercedes, do I expect to pay more for a Mercedes? Of course I bloody do. Yet we allow sometimes this conversation to become overly fixated on cost alone, when in fact our job is to deliver the right outcomes for clients. So the engagement with clients was very much about the strengths and weaknesses of both options. And don't underestimate it. One of the points I would make on this, Brett, is that when you decide I'm going to make these changes and implement, it's a statement of advice for every client. It's 12 months of active engagement where you really, really work hard. So you've got to believe in the benefits for the client and the benefits for you on the other side of this. However, and sorry, and one other point I'd make on that, don't do it by half measures.
Yeah.
Don't, if you're going to make a decision like this, you need to drive it and drive it hard as a project to get a clear outcome on the other side. Bring all of the clients across. Yeah. The ones that you leave behind are the ones that you are going to get burnt with in the future if you're not very careful. So it is a lot of work. It takes some, you've got to think out your communication. You need to draw graphics like the one that I was just showing you, which allows you to communicate effectively and give understanding to the clients.
Tim, just in finishing, I've heard you, use some words around what your role is with the client and a roller coaster being involved in that. What do you typically say?
Well, how to make yourself look really simplistic. But, funnily enough, I find the most powerful communication. I mean, it's interesting. I see some people take different approaches about how to engage clients. Yeah. I remember watching an advisor do a seminar once, and let me tell you, after 45 minutes of him talking, I didn't have a clue what the hell he was talking about. And his whole philosophy was, you see, that's why you need me.
You need me, yeah.
Which is okay. That may be your approach. We take a different philosophy. We actually believe that it's our responsibility to provide our clients with understanding. And so the analogy that you referred to is one that I use with a lot of clients where, Mr. and Mrs. Jones, basically what we are is glorified roller coaster attendants. By the way, I actually learned this at Dreamworld many years ago with my young children, who are now a lot taller today, standing there waiting in the line to get on the roller coaster at Dreamworld. And I lived, by the way, so that's a good thing.
Yeah.
Anyway, I'm standing there in the line, I'm bored, I've yelled at the kids, we've been standing there for 45 minutes. And I'm watching this guy, he's got this great little uniform on, he's got a hat, he's chatting up he's having a great time. And I'm watching him and I thought, oh my goodness, he does my job. He actually has the same, I might be the sucker down on Collins Street in the suit, but we do the same job, because his job fundamentally is to make sure you get on the right roller coaster. That's about structure. It's about engaging the clients. What's right for the client? How do we build a bespoke solution? But the absolute core of our success or failure is how we impart in the client the ability to remain seated for the duration of the ride. And the difference between our jobs is the roller coaster attendant has that great mechanical buffer to squash you into your seat. All we've got is the logic and the understanding that we build into our clients. And I think, it's interesting during times like this, because this is when we get to do the exam. This is when we get to find out how well we positioned our clients for the reality of volatility. We've got to stop acting surprised by these things. Now, I'm not sure whether it's only when you get old and bald and you've gone through this enough that you kind of go, well, guess what? I'm not going to lose any sleep. One of the promises I make to clients is the fact that I guarantee you there'll be another GFC, GVC, I think we're calling this one, whatever. There's another one coming. Promise you that. Yep. And what we have to do is set you up to be able to manage that accordingly.
Right. Tim, was that a call from the golf course to say you're ready to
no, it was a call
13 hours?
It was a call from She Who Must Be Obeyed, and I need to go to it, unfortunately.
Okay, well, we better get you off the line. But Tim, thank you so much for sharing your insights. I'm sure this would have been hugely valuable for a lot of people that are sort of going through that. What do I need to do in my business? Let's review where we're going, what we're doing. There's a lot of change happening in the industry, and a lot of exciting opportunities to do things much better. So for all of those that have been here for this 30 minutes or so, thank you for investing your time. Hope you got lots of value from it. Please reach out to either your BDM, your Hub BDM, or if you want to send an email to hub24.com.au, and we can put you in touch with different people in the business who could help you. Again, Tim, thanks very much. Really appreciate it.
My pleasure, Brett. You take care.